We hear about these massive, splashy tech IPOs all the time. The ones that dominate the headlines and seem to make everyone rich overnight. Well, this explainer, this isn't one of those stories. This is about what happens when the ambition becomes an anchor, and a Wall Street darling takes a very, very wrong turn.
Right. Think about a company like Figma. Total rock star. The kind of IPO investors dream about. Now just kind of put a pin in that, because the company we're diving into today, Solera, is basically the polar opposite. This is a story bogged down by lawsuits, sluggish growth, and a truly mind-boggling mountain of debt.
So let's unpack this. We're going to get into the weeds on Solera, a giant in the auto software industry that you've probably never even heard of. And we're going to explore the massive, multi-billion-dollar problem that is threatening to pull the whole thing under.
Okay, so it all boils down to this central mystery. Let's call it the $8 billion question. And there it is, over $8 billion. And just to be clear, that's not the company's valuation. Nope, that's how much debt it's carrying. This one number is what's absolutely crippling this software giant and forcing it into a corner. And believe me, that debt is just the start. Their big plan to go public and raise cash? Yeah, that got put on hold indefinitely. Their credit rating? S&P slapped it with a junk rating. On top of all that, the company is bleeding money, and new auto tariffs are just squeezing them even harder. It's a perfect storm.
So you gotta ask, right? How does a company that was a leader, an empire built on deal-making, end up in a spot this bad? To figure that out, we have to turn back the clock.
To really get what's going on, you have to look at the company's DNA. From day one, Solera was an empire built on deals. That was its whole identity.
The whole business was built on this one strategy called the roll-up. And the concept is pretty simple, really. You just go out and buy a ton of smaller companies in the same industry, you stitch them all together, and poof, you've created a giant. The goal isn't to innovate or grow organically. It's to get huge, fast, by buying up the competition.
And man, were they aggressive. They launched in 2005, and just a year later, they made a nearly $1 billion acquisition. By 2007, they had their first IPO, using the cash to pay down some debt. And then, the feeding frenzy began. For the next 8 years, it was just go, go, go. Over 50 acquisitions, spending billions to build this empire. But by 2015, you could start to see the cracks forming in that empire. And that led to the single biggest turning point in this whole story, the private equity gamble. This is the moment where everything, and I mean everything, changed.
So why did a private equity firm suddenly get interested? Well, the numbers tell you everything you need to know. Look at this. In just 2 years, revenue growth just totally flatlined. And even worse, profitability completely fell off a cliff, from a pretty healthy 12.5% margin to losing money. The roll-up strategy was just out of gas. For a public investor, that's a huge red flag. But for a certain type of private equity firm, that's blood in the water. That's an opportunity.
And that's where the leveraged buyout, or LBO, comes in. This is a classic, high-stakes Wall Street move. You're basically buying a company not with your own cash, but with a ton of borrowed money, debt, that you then load onto the company you just bought. The plan, the hope, is that the company can generate enough cash to pay it all back for you. It's a massive, massive gamble.
And this right here is the gamble that Vista Equity Partners made in 2016. They took Solera private in a $6.5 billion deal. But look at this chart. A staggering 60% of that price, almost $4 billion, was brand new debt loaded right onto Solera's balance sheet. This is the moment the company's fate was sealed. You can see the debt spiral happen in 3 really clear, painful steps. The company was already carrying almost $1 billion in debt before that first IPO. Then, bam, Vista's LBO adds another $3.9 billion. And with more deals and all that interest piling up, that number has just ballooned to over $8 billion today. You just can't carry that much weight forever. Something's got to give. And that's when you start to see the cracks in the foundation.
Now, you'd think after taking on all that debt, they might, slow down a bit. But no, they kept on buying companies. And the consequences were just brutal. In 2024 alone, they paid almost $1 billion just on interest. They lost nearly $500 million in cash. And it turns out Vista apparently tried to unload the company back in 2021 and couldn't find a buyer.
The model was clearly broken.
And eventually, all this turmoil spilled out into the open. In 2019, the company's own founder, Tony Aquila, sued Solera for over $100 million. The whole thing was described as a public spectacle, and it just showed how deep the rift was between the guy who built the company and its new owners.
So you take all these threads, the roll-up strategy, the LBO gamble, the crushing debt, and they all lead to right now, to this crisis. It leaves Solera on what looks an awful lot like a road to nowhere.
So why even try for another IPO in 2024? Well, it wasn't about funding some exciting new project or innovation. The company's own filings made it painfully clear. The goal was one thing and one thing only: to raise enough cash to pay down that crippling debt. It was a lifeline.
And the stakes for Vista Equity Partners, they are absolutely enormous. They bought the company for $6.5 billion. If they can somehow pull off an IPO at a $13 billion valuation, they'll double their money. Great success. But if the market only thinks it's worth $10 billion, their return could be a fraction of what they put in. The pressure is on. This all creates this massive gap between hope and reality. The hope was a clean, successful IPO that solves all their problems and makes investors happy. But the reality? The IPO is on ice, the company's credit is junk, and let's be honest, today's market is not exactly thrilled about slow-growth companies that are drowning in debt.
So what is next for Solera? It's a company stuck at a crossroads. It was built on this acquisition strategy that feels kind of old school now. It's suffocating under the weight of a private equity bet, and it's staring down a public market that has very little patience for a story like this.
And that really leaves us with a much bigger final question. This story isn't just about Solera. It's a case study. In today's economy, with high interest rates and so much caution in the air, is the whole leveraged roll-up model a signature move for private equity for decades? Is it fundamentally broken? And that is the $8 billion question that goes way beyond just one company.